As it swings in the other approach to counteract a dramatic global recession, China is pressing central banks in the West not to raise interest rates too quickly to tackle inflation. As the nation continues to recover from the coronavirus outbreak, Chinese President Xi Jinping appealed to major international economies to fuel recovery by coordinating their policies. Hey, welcome back to Economic Insiders. Give this video a big thumbs up, and don't forget to subscribe to this channel. It's free. Now, let's move on. The Federal Reserve emphasized last month that interest rates may be raised 3 times in 2022, while the European Central Bank announced in March that it will stop its crisis-era bond buying program. Last month, the Bank of England raised the rates, becoming the first major bank to do so since the epidemic emerged. Central banks in Eastern Europe and Latin America have also aggressively hiked interest rates to limit inflation. Many nations in Asia, Africa, and South America are alarmed about the U.S. Federal Reserve's plan to initiate a series of planned interest rate hikes this year and begin nearing the end of its fiscal stimulus plan. The Federal Reserve has been under great pressure to act in response to increasing inflation, which reached 7% in December, the highest level in 40 years. Higher U.S. interest rates will make financing dollar-denominated relatively more expensive. Bank of England and European Central Bank policymakers are also likely to tighten monetary policy in the coming months, escalating the risk of indebted countries failing to meet loan repayments. Meanwhile, China is adopting a different strategy as its economy slows and it continues to grapple with the issues of sustaining momentum while sticking to its zero-COVID strategy, a rigorous policy of closing off places to avoid outbreaks that have isolated the nation from the rest of the globe. On the 2022 World Economic Forum, Xi told, "The global industrial chains and supply chains have been disrupted. Commodity prices continue to rise. The energy supply remains tight. These risks compound one another and heighten the uncertainty about economic recovery. If major economies slam on the brakes or take a U-turn in their monetary policies, there would be serious negative spillovers. They would present challenges to global economic and financial stability, and developing countries would bear the brunt of it." Xi was referring after the latest data revealed that China's economy slowed at the end of last year to 4% in the 3 months from October to December compared to the same time in 2020. The National Bureau of Statistics reported the slowest increase in 18 months due to the COVID-19 outbreak and the property sector crisis. China's economy grew by more than 9% in the first 3 quarters of 2021, but it has slowed sharply since the summer, causing Beijing to reduce a crucial interest rate. Analysts criticize Beijing's zero-tolerance policy to the COVID-19 virus, which involved banning all mobility in places with only a few cases. Retail sales growth dropped drastically to 1.7% year over year in December, down from 3.9% in November, as per the report. The impact from the crisis at bankrupt property developer EVERGRANDE plunged into China's economy as well. China's second largest developer is on the edge of becoming the country's largest ever bankruptcy case, and its collapse has triggered a larger real estate meltdown. It has amassed debts of over 2 trillion yuan, or 2% of GDP, owing to creditors ranging from individuals who bought high-yielding investment products from the company to the country's top construction businesses and banks. All of these crackdowns have combined to put immense pressure on some of the country's greatest employers, local governments, and business contributors to growth in the economy. So why Evergrande is in trouble? Evergrande borrowed more than $300 billion to expand rapidly and become one of China's largest enterprises. But Beijing implemented new restrictions last year to limit the amount due by large real estate developers. Evergrande was forced to market its properties at heavy discounts as a result of the new rules, to ensure that enough money was streaming in to keep the firm solvent. It is now failing to make debt interest payments. Because of this volatility, Evergrande's share price fell by about 90% in the past year. Can Xi stop Powell from raising interest rates? Chinese President Xi Jinping's effort to put the integrity of the Federal Reserve Chairman Jerome Powell to the test is expected to divert the world's most powerful central banker's attention away from his fundamental task of tackling inflation. It is also unlikely to help ease China of the pressure it will face if the world's largest international creditor to emerging nations and it declines to forgive borrowers who are unable to repay their debts when global interest rates rise. But Powell, who is planning to raise interest rates to 4 times this year, has faced strong language from blunt leaders in the past, including frequent criticism from the then US President Donald Trump for raising interest rates 4 times in 2018. The fear of harming the typical American by raising mortgage rates was the empathy test back then. Today, it's underdeveloped nations. Xi may be fine with a little extra inflation because it helps to cut the cost of debt naturally. In China, the rate of inflation is merely 2.3% compared to 7% in the United States. Xi, on the other hand, is concerned about future debt commitments. The World Bank warned this week a group of 74 low-income countries will be obliged to repay an estimated $48.6 billion to official bilateral and private sector lenders in 2022, a 45% growth from 2020. The G20 debt service suspension program expired last month, and the IMF's Catastrophe Containment and Relief Trust are expected to expire early next year. The IMF has also indicated that unless G20 creditors provide more debt relief, some low-income nations may risk an economic catastrophe. So now, we will have to wait until March, when the Fed is expected to raise interest rates for the first time, for any estimation of how this all will work out.